Hello everybody and welcome to this Friday morning video entitled The Most Undervalued Growth Stocks, and this is a video where I cover the stocks in my coverage universe, stocks that I talk about on the channel all the time. And what I do is I evaluate these stocks based on their growth valuation. I do this a little different from a lot of the other YouTube channels in that what I care about in this channel is hyper growth stocks, i.e. I want more than 30% growth. The reason for that, more than 30% revenue growth, the reason for that is because I'm trying to double monetary inflation, which I estimate at 15%, which is the reason for the channel being named Beat the Denominator. I'm trying to beat monetary expansion, the M2 expansion on M2 plus euro dollars. And in order to do that, you have to have a stock that grows at least faster than the rate of monetary expansion, which is why I focused on these high growth stocks. And more specifically, the type of investing that I do is I invest in megatrends, in companies that have products that are new to the market, and entirely groundbreaking, disruptive companies. So companies that are often misunderstood. One of the most common comments that I get on my stocks is that, they make no sense. If you own Tesla, for example, you're very used to hearing this about your stocks. And a lot of these stocks fall into this category because they are new, because a lot of people don't understand this stock. This is the style of investing that I have. What I try to do is I try to buy stocks early on at the early signs of adoption, right at the stage where innovators adopt the product and early adopters. And I try to sell the stock, of course, once the products become widely adopted and once everybody uses that product. A good example would be buying something like Apple, say, in 2010 and selling Apple in 2022. Nobody had a smartphone. Now everybody has a smartphone. Time to sell the stock. Most of the gains are gone. This idea of product adoption applies well to most of the stocks in this video. For example, electric cars. Tesla would be an example. It's still less than 5%. We're still in the early adopter stage. Probably a stock that will be sold or will need to be sold sometimes in 2035 as an example, because product adoption of new ideas, new products typically takes 10 to 15 years from the moment you reach that 5% threshold, which is the make it threshold, right? Some products don't make it, and that's why I also don't look at pre-revenue companies or companies that are at the R&D stage. It's too risky, it's too early. You need to have that 5% adoption to be sure that you have something real going on right there. And because these companies are so early, these companies that I follow, I need to focus on gross profit. Gross profit is the most relevant metric for this style of investing, right? Using earnings makes no sense because these companies reinvest heavily in their products and, oftentimes in the form of operating expenses. These expenses are not always capitalized. This is the whole story of Amazon, for example, if you follow all of these accounting debates. But that's the main reason as to why you really can't use earnings for a lot of these companies. For a lot of these companies, you can only use gross profit, in my view. And these companies are optimized for gross profit. And I'm just making this easy back of the napkin, maybe naive assumption that these companies will do a good job after the gross profit and will respect their fiduciary duty towards the shareholder. So that's why I focus on the gross profit. And really briefly, the most important metric that I use is enterprise value over gross profit over revenue growth. The reason why I use enterprise value is because I want to penalize companies that have a lot of debt. Enterprise value dings you, right? Dings the company for having debt. And I think it's better to use that. Gross profit, that's what these stocks are optimized for, and then revenue growth. This is a spin on the PEG ratio of Peter Lynch. This is my modification of Peter Lynch's PEG ratio, but I don't use earnings. Of course, I use revenue growth. And the question that this answers is, how much are you paying for each percentage point of growth that is expected over the next 12 months? How much are you paying? Is that growth expensive or is that growth cheap? And what I do in the spreadsheet now, I'll get started right away. I'll go through the cheapest stock on the spreadsheet, not the best stocks to buy, not the best total return stock in any way, but cheapest. I'm only saying these stocks are cheap. The cheapest stocks right now are HIMS. HIMS is back at it and is back the cheapest, followed by StoneCo. StoneCo is a second. Yeah, HIMS has been dropping almost 30% for 5 days, so now it's back the cheapest. HIMS and StoneCo are really, to me, an amazing combination. Two stocks that I really like for my undervalued plays. Then another one is a micro cap called Lovesac. They're known for kind of bean bags, kind of a competitor to the Lazy Boy couch, if you're familiar with that. Then I have STEM. STEM is an installer of huge battery packs for utilities and for industrial sites. Then I have SOFI and Nubank. These two stocks are very, very cheap. SOFI and Nubank, as far as how much you're paying up for that growth, they're really trading in line, which is very interesting to me. SOFI is obviously more US oriented and Nubank is Latin America. And then you had Indie Semiconductor, which is a more of a micro cap in the semi space, helping OEMs. So what you notice is that yes, many of these stocks tend to be micro caps, although some of those stocks are smaller than others. But for example, StoneCo and HIMS would be on the bigger side, and the banks as well. But anyways, that doesn't really matter too much. Let me move on to the expensive stocks, and these expensive stocks are Nvidia. Oh my goodness, Nvidia. I can't even begin to comprehend how expensive Nvidia is right now. I've sold that stock. I used to own it, which is the reason why it's on the spreadsheet, but I've sold out. And then the other one that I find very expensive is Shopify. I only put two expensive stocks in there, but I could have easily added other stocks, such as, for example, Snowflake, which in my view is getting very, very much overheated and quite expensive right now. So what I do briefly today, and I'm on vacation, so I'm going to try to go faster than usual, is I go through each stock in each of my megatrends. You can see my categories here. I try to pick a few stocks in each of the megatrends. I try to pick the winners, right? It makes very little sense, in my view, to buy every single stock in a basket that loosely fits a category. I'm trying to find the winner within each category, and these categories are obviously major megatrends that I believe in, that I like to invest in. So my favorite megatrend of them all is the energy revolution stock. The world we live in depends on energy. There is nothing we could do without energy. Energy is the very reason why 9 out of 10 people don't work in agriculture anymore. You go back 200 years ago, agriculture was the only thing you could do because you needed to work 10-hour days just to feed yourself. That has changed because of energy. Energy is fundamental to everything we do, and energy is going through a revolution right now. We had coal, we had steam engines, we had oil and gas. Today we have another revolution, which is called electric engines and electricity and renewable electricity to a lesser extent, as well as batteries. There is this very, very strong revolution. Energy revolution is riding the cost curve of consumer electronics. We need to understand that much of this revolution is happening because of batteries and because of how good we've gotten at batteries, right? The electric cars have been around for well over 100 years. In fact, the very first electric cars were electric, but they were never feasible because we never had a battery good enough. If you study the innovation of Tesla, you know that the innovation of Tesla is cylindrical battery cells. Cylindrical, why is Tesla not using pouches but using cylindrical cells? Because they can be manufactured just like the batteries of laptops. And that's the whole story of Tesla in the early days. If you read books on Tesla, the early day books, it was all about these round shape batteries that you can ride the cost curve of laptop batteries. And that's the whole reason why everything out here is possible. The same is true for Enphase. Enphase is solar energy. Solar energy is possible because of the advances that we've made in semiconductors. Moore's law advances in manufacturing, how much better we've gotten. Now our solar cells, which use silicon, just like our chips, get better and better and better. And if you look either at solar or batteries, you know that the cost of these technologies has been divided by 10, i.e. one order of magnitude in about 10 years. And could it go another division by 10? I believe so. I believe that's what we're going through, and these technologies are going to win. When a product is so cheap, they're going to win. I like to say when I talk about Tesla, doesn't matter how much you hate electric cars, doesn't matter how much one loves the story around gas cars and the history and the fun and the childhood memories of gas cars. It doesn't matter when it's, $6 to $7 for 400 miles, right? 700 kilometers for $6, $6. That doesn't matter. It's going to get adopted. And that's what I think a lot of people still don't get, is it's going to get adopted not because of the environment, but because it is cheaper. It is one order of magnitude better at least. Probably more than one order of magnitude when you add other things, and that's the energy revolution stocks. And Enphase and Tesla are two stocks that I really believe in, even though their valuation right now is not the best in the spreadsheet. Enphase actually is cheap right now. It's much cheaper than Tesla. I've been adding to Enphase a little more than to Tesla, despite the good news that we've had on Tesla. It's I would be silly not to mention the good news of Tesla, new CEO at Twitter, new products coming, Cybertruck on track. There's a lot of good news for Tesla as well. But these companies, to me, I view as foundational in my portfolio. Really like them. STEM is an installer of battery packs for industry in general, and they're actually the number one installer of Tesla mega packs, believe it or not, which is very interesting. They have a software. That's one of the main reasons why one would invest in STEM, is to invest in the Athena software. STEM is the microcap, the riskier, more speculative stock of the bunch here, but I have a tiny position in STEM, and I think this company is an interesting bet, but nothing as substantial, of course, as Tesla or Enphase. Let me move on to another revolution. What's another revolution right now? It's healthcare. I've covered HIMSS quite a bit, actually, over the past week, even though I'm on vacation. I follow HIMSS quite a bit, and I believe this company is a company I've been looking for a while, either as a customer or as an investor, which is a company that tries to do preventative healthcare. Or if you use my definition, they are trying to do healthcare, while most of the insurance and hospital world is trying to do sick care. And I think there's a fundamental distinction. HIMSS is a agile company. It's a company that operates outside of the insurance system, that is able to provide treatment for a lot of chronic conditions that people may get in their 30s, their 40s, 50s, typically smaller conditions that are essential to living a healthful life, but that most of the time the sick care system will overlook. Things like hair loss for women or ED. These tend to be things that are overlooked, not covered by the traditional sick care insurance, and HIMSS is fixing that, and it's using a consumer brand to fix that. It's my favorite company in the space. I used to be an investor in Teladoc. I used to like Teladoc, but I have sold out of Teladoc because I actually see that the growth has stalled way more than I would ever thought it did. That's A, for reason number one, reason A, why I sold. The other reason why Teladoc I sold out is it's clear that the Livongo acquisition was not a very good acquisition. They've made mistake. Even their mental health business, which is supposedly doing amazing, is not doing that well because it's competing with companies like HIMSS who also provide mental health. So I am disappointed with Teladoc. I would get back in if growth resumed, but unfortunately it doesn't seem like it's resuming anytime soon. And if you look at HIMSS just raised its growth outlook. It just raised it, and now next 4-quarter outlook is still forecast at 56%, which is absolutely outstanding for a company like HIMSS. Let me now move on to companies that I haven't been adding to as much because they've gotten so expensive. I mean, these companies have had a run over the past few weeks. It's Datadog, Snowflake, Palantir, and MongoDB. These companies are what I call my data stocks. They're data warehousing, data lakes, data monitoring stocks. Datadog is more of an infrastructure monitoring stock. Perhaps, in my view, the most interesting stock out of the three in there, and that is knowing that I put Palantir in a different category. I actually own Palantir for the military business. As far as Snowflake is storing your data in the cloud. They have a big player of data sharing. They have a network where you can share your data with your other companies. Snowflake, interesting company, but the growth has just stalled, like entirely stalled. And then MongoDB is kind of a niche in the sector, but it's a NoSQL databases, and it's a special type of database that is really liked by developers. I'm not adding to these companies because I find them expensive right now. Moving on to CrowdStrike, Zscaler, and Cloudflare. These companies are, aside from Cloudflare, which is a little expensive, although it dropped quite a bit, and it's if you really like Cloudflare, I would argue you're nearing a strike buy, like you're nearing a buy zone if one really likes Cloudflare. I think it's still too expensive for my blood, and because they may have competition from Microsoft. They have competition in the DNS space. Cloudflare is kind of a firewall for website. At least that's how I try to explain it. It's kind of a firewall for website. Cloudflare, I'll put it as a special situation in the cybersecurity space. In the cybersecurity space, I like CrowdStrike and Zscaler. I think these companies tend to go hand in hand. Zscaler is the cheaper stock, but Zscaler has competition in zero trust. CrowdStrike, however, is the top stock in the space. CrowdStrike is endpoint security. Now, one of the issues with CrowdStrike right now is that there's a lot of layoffs in tech, and because these are device-based software, these are software where whenever you issue a laptop, you issue a device, there's a monthly fee. Some people are afraid there may be a slowdown, but CrowdStrike is nonetheless my favorite company in the cybersecurity space right now. They've issued long-term guidance. I've put out a lot of long videos on CrowdStrike. I think it's interesting, although I will say that endpoint security typically will go hand in hand with zero trust, and I think the combination of CrowdStrike and Zscaler makes sense. And cybersecurity is obviously a mega trend of today. There used to be a time where physical security, walls, fences, castles, all of that good stuff was important. Well, today we live in a digital world, and cybersecurity is of the utmost important because those walls can be broken, and so that's why these companies are I think at the heart of their megatrend. Let me talk to e-commerce. E-commerce is an old megatrend actually, which is why I would never put a company like Amazon in there, because Amazon is becoming, it's about halfway through the growth of its megatrend, and it's becoming more mature. In the US, I have Shopify for e-commerce. I think Shopify is very expensive. I am out of Shopify. It's a Wall Street darling. Amazing company, great business, bad stock. As far as the two stocks I'm interested in, it's MercadoLibre and Sea Limited. Sea Limited, I don't think the last quarter was too much to get excited about. I think it's a pretty much the same story as it's been for almost a year now, which Sea Limited has an issue with its gaming division. The gaming division is weighing on the benefits of the e-commerce division, and so because of that, it's not exactly a pure play e-commerce. I much prefer MercadoLibre. MercadoLibre is my favorite company in the space. It is a leader in Brazil and in Mexico and in many countries of Latin America, such as Argentina. One of the big risks of MercadoLibre is currency risks. For example, with Argentina, they've done an outstanding job growing despite the devaluation of the Argentinian peso, because they were growing over there at something like 160% year over year, which if you remove 100% inflation, you're still at 60% growth. So they seem to be able to operate in markets that a lot of international companies just can't or just don't do well. Amazon is not doing very well in Latin America. MercadoLibre, another very bullish thing, which the market is so short-term it doesn't seem to notice. MercadoLibre, of course, major player in Brazil. They had Americanas, which was their main competitor in Brazil, which went bankrupt. So their main competitor went bankrupt. So lots going for it. Lots going for MercadoLibre. Still growing above 30% a year. Still, I think a lot of room to grow. So this is for my e-commerce megatrends and e-commerce growth stocks. As far as the payments companies, I'll go very quickly on that one. I won't cover DLocal or Square too much. First of all, these two companies are more expensive. DLocal allows to pay online in multiple currencies with all different types of payments and typically caters to bigger companies that try to sell digital services online. And Square is obviously in the US the Cash App and the Square terminal payments. This company is a leader in its field, although growth has stalled in Square. The reason why I'm a little bit cautious about both DLocal and Square right now is because they're under attack by short reports. And if you follow, for example, Carl Icahn's companies, you know that short reports, they're relentless. They can really hurt a stock. So that's one of the reasons why I'm not adding to the stock. However, StoneCo, I am still as bullish on StoneCo as I used to be. StoneCo is a simple value proposition. It is Square payments, Square terminals for Brazil. They're essentially a duopoly in Brazil. They have PagSeguro as their main competitor, but it's essentially two players, and they have a lot of community involvement. They're well knit into the Brazilian society, and this company has been growing really quickly despite its dirt cheap valuation. And like Estonia, I think it's a culturally relevant company over there, and it's in a position to be the quote unquote Square of Brazil. So I really like that company, and I like that exposure to Latin America. What I find oftentimes is that Latin American stocks, it's an area that is close enough to Europe and the US that I can understand it, and it's got a lot of growth potential, from at least what I can read. Let me move on to the chip makers. Oh boy, that's a tough one. So let me just go ahead and say INDI is in this category, but of course the market cap makes it so risky, so small, so subject to manipulation by the market, short sellers, etc. INDI is a promising company, but very early on. Why it's so cheap? But the revenue growth for the next 4 quarters is estimated to be 100%. INDI is a maker of electronics like ADAS system, entertainment systems for cars that are intending to compete against Tesla, essentially. So they have an interesting positioning, founded by industry veterans in the chip space. The two elephants in the room, if I may say, are Nvidia and AMD. Now, Nvidia has gotten out of hand. I mean, it's almost a $1 trillion valuation for Nvidia. I cannot understand how expensive this company is. They've guided great growth for Q2, but it's what they've guided. It hasn't realized, and there's no guarantee that it will go on for the 4th quarter. So I don't know. It could be hype. It could be real, but it sure feels to me, when I made my video 2 days ago at Nvidia, it sure feels to me like Cisco in 2000. If you follow that chart, that's what it feels to me right now. Because yes, their data center GPU products are doing so well, but their gaming division is not doing too well, for example, and that used to be a big chunk of their business, but they've lost. So very cyclical business in my view, and so expensive, too expensive in my humble opinion. If one has to be in that space, AMD, I believe, is a better buy if one has to be in that space. Although this video is just entertainment, of course, but one may have to question whether they even want to be in that space, quite frankly, because AMD you'll find correlated to Nvidia. You know, when Nvidia is up 25%, AMD is up 10%. These companies are correlated because there's overlap in some of what AMD does with Nvidia. AMD is a more diversified company in the chip sector. It's also an older company. AMD is actually a 50-plus-year-old company. Very interesting to me. Let me move on to ad tech. I don't have much to say about ad tech except that ad spending is way down. We are in a recession right now, so could be an interesting moment to look at it. These are stocks that I've owned for a long while, especially the Trade Desk. Trade Desk is quite expensive. It's an expensive stock. It's always been expensive. Ad tech right now is a sector that I'm not covering too much because I'm not adding, and I'm staying away from that sector a little bit. These are old position, and I'm just letting them run, waiting for the economy to come back and the Fed to drop rates and the world to boom again. And I think these stocks will do well when that happens. If you own Google, by the way, which is not a growth stock, but if you own Google, that would be kind of in the same situation. These companies are very dependent on marketing spending, ad spending, and ad spending is itself very dependent on, I will say, the macro of the now. I.e., it's the first thing you cut, and it's the first thing you turn back on. So interesting play in my view. Then I have what I call my lifestyle stocks, and I've also put new stocks that I've added to the channel within the past 2 weeks in here in my lifestyle stocks. The reason why I cover lifestyle stocks is because I believe that there is room for new brands. You know, with new technology, with the internet, and with the end of television, new brands can be created. You know, it used to be that brands were created through television, and now people don't watch television anymore. And so if you don't watch television, you know, there's no way a brand like Tide will mean anything to you because there's no evening news that they can advertise to half the country, and the barrier to entry in advertising is gone, and that leaves room for new brands. One of them is Celsius. I think Celsius is very interesting. There's a lot of comparisons that can be made between Celsius and Monster Beverage. If you follow the stock market, you know Monster Beverage was one of the top performers out there. I like Celsius. I think the price, if we can actually achieve that growth, is not that high. What I don't like about Celsius is that the Pepsi partnership is a double-edged sword. Yes, Pepsi is helping them grow so fast, but Pepsi may buy them one day. And I find this to be a little concerning because, of course, if that happens, yeah, the stock pops 30%, but then you don't have a stock anymore, and that's not what I'm trying to do. I'm trying to be a long-term investor. Lovesac, the reason why a company like Lovesac, which focuses on sectionals and couches, kind of a sectional 2.0 type of business, competing with a lot of legacy furniture. The reason why the stock is down is because obviously nobody's ever going to buy furniture anymore because interest rates are high and nobody's buying a home. So obviously furniture is dead forever. Nobody's ever going to buy furniture anymore. That's literally what the market is thinking right now. It's not the case. People are still going to buy homes, right? This is an issue of Keynesian economics to think that just because you have an economic crisis, people stop living their lives. No, they don't stop living their lives. People go out and buy a home because they need a home. They go out and buy a couch because they need a couch. Anyways, sorry about the tangent. Stock is very, very cheap because the market is associating it with the death of real estate as a whole. And if you look at a lot of the other stocks in that same sector, it's the same thing. Yet this company is still growing. This company still has interesting positioning. Obviously, the most interesting thing about this company is that you have an enterprise value of $437 million and the revenue is $651 million. So this is a company that trades below 1 to sell. The price to sell is below 1 for this company, which is absolutely insane. I mean, it's pretty crazy with good gross margins as well. 53% is pretty good. Then you have Figs. Figs is trying to do what Lululemon did with the yoga pants. Figs is trying to do this with the scrubs, and that company, the growth has stalled, and so I'm not adding to it. I'm a little disappointed with the direction of it. But nonetheless, very interesting company to study. If they can pull it off, look up the performance of Lululemon, and you'll see how big it can be, creating new brands new meaningful brands, taking advantage of a death of the mall, the end of mall brands, and trying to replace them with new brands today. I think that has a lot of potential, but nonetheless, not doing too well this one, and probably because of a slowdown that we see in the healthcare sector. That's probably one of the reasons. DigitalOcean, this is a cloud provider for startup, for small companies, for small businesses. Steady Eddie business. The growth is a little low at 25%, but the margin is high. One of the small issues that there is for DigitalOcean is that they're going to have to refinance some of that debt, and so we'll see what happens to the rate environment in 3 years, about 3 years for them. In 3 years, we'll see where rates are at. That doesn't bother me because I mean, that's why I named the channel Beat the Denominator. The Fed will pivot. There is no doubt in my mind. So to me, they'll be able to refinance. But if you believe that the Fed will keep interest rates high for like 3 or 4 years, very risky stock to own because they have debt to roll over. Lastly is AXON. AXON is kind of similar to DigitalOcean, as a steady Eddie stock, very stable business, focuses on local police departments, selling to police departments. Really, really steady business. A little bit of Chinese competition, especially with like the new cameras that they sell, etc. In Europe, they have a little bit of headwinds with their taser systems. Not too good of a reputation, but still the company is doing fairly well. I would argue interesting play, interesting company. Let me move on to the neobanks. So why are we interested in the neobanks? Well, obviously, I believe it is a major trend that people will adopt neobanks and stop going to branches. Cash is a thing of the past. I've been out quite a bit over the past week and a half, and I'm always impressed by how many places are cashless. Oh, we are cashless. We've gone cashless. We don't take cash. Well, if you don't have cash, if you don't take cash, you don't need ATMs anymore. You don't need banks anymore. And that is branches is what I mean, bank branches. And that is what these companies are doing. They're disrupting consumer branch banking, and they're disrupting that with an app. Nubank is doing it in Latin America. SoFi is doing it in the United States. I believe both of these stocks, but SoFi more than Nubank, but SoFi especially, they can't catch a break. Like the market keeps battering them, and in my view, that's why I hold the stock. In my view, one day it will pop. One day these stocks will go up. For SoFi, it's getting rid of that student loan overhang that the market keeps associating SoFi with. The day the student loan overhang is gone, I believe SoFi will shoot up, but poor SoFi, it's been beaten up by the market. I've rarely seen the market be anti one stock for so long, like even Tesla. Anyways, just my own point of view. I like both of these. I think they're a leader in their respective consumer banking sector, neo consumer banking, of course. And keep in mind, like when you analyze the banks, it's easy to go ahead and look at a big bank and say, oh, look, this bank has trillions of assets. What's going to happen to these banks? These banks are meaningless. But remember that it's about the future. It's about where are the deposits headed. Where are deposits going? And I believe the next generation, they're going to bank with those folks. They're not going to bank with the old folks with the big fees. At least that's what I'm betting on. I may be wrong, but you don't need to be right on every single stock. You just need to be right on, a few multi baggers. That's the nature of this type of investing. Let me finish with platforms. So the reason why I focus on platforms is because it's the business model of the internet. It's the business model of the 21st century. Two-sided platforms specifically, right? So not like a Netflix, for example. Netflix is a one-sided platform where they have a lot of network effects on the consumer side, i.e. people browsing the shows, right? But they have no network effects on the producer side, which is Netflix has to put up the money to make the shows, right? YouTube is a two-sided platform where they are kind of a toll road on both the creators and the watchers. And if you look at all of these platforms, they are two-sided platforms, right? So Airbnb doesn't have to come up with any capital for rooms, for houses, for any type of experiences that they book. And they also don't have to spend much on marketing to acquire buyers. So it's a two-sided platform. It's a self-fulfilling loop that goes on and goes on. And that's why Airbnb, of course, today provides more accommodation than any hotel brand around the world. And actually, if you look at all of the Airbnb accommodations that they provide worldwide, it's bigger than all of the hotel rooms in the United States combined. And this is a company that is less than 15 years old. So just to give us an idea of scale, I believe in Airbnb. I know a lot of people don't like Airbnb. A lot of people don't follow this stock at all, which is surprising. Must be the YouTube crowd. I think a lot of people on YouTube don't follow this stock. This would be a company, for example, that I think would be much more popular on, say, a platform like Instagram, for example. But I don't use Instagram. So, anyways, I think it's an interesting play. They're also trying to disrupt the mom and pop rental business, where you don't sign a 12-month lease anymore. You just go on Airbnb and do a minimum 2 weeks rent, and people will just live in Airbnbs, which is part of the thesis as to why some people really like that stock. Etsy is kind of a similar story, but for crafts. I think what Etsy has been able to do with crafts, monetizing an activity that was mostly a hobby and turning it into a business and monetizing it. It doesn't get more blue ocean than this. It's like you're not competing in a red ocean. You're not going into a crowded space competing against other established players. You just innovate, create your own space, create something that totally didn't exist, which was this whole craft idea. And so and of course it created a lot of induced demand, right? Demand that wasn't there before. It used to be, no, you're not gonna get that custom Christmas ornament. That's not possible. You're gonna go to Walmart and get a Christmas ornament. Now you can get the most obscure, crazy Christmas ornament possibly made and customized. So there's a lot of induced demand, right? Sales that would not happen if it were not for a company like Etsy. Etsy is 90% women, though, so I know a lot of my audience is not going to be too familiar with Etsy because the channel is 98% men. And lastly is Fiverr. Fiverr is selling microservices, right? So you're selling, I'll make you a logo. I'll read a jingle for your company, 30 seconds, and you just charge a few bucks. Lots of people are fearful that ChatGPT may earn Fiverr, but as I've said multiple times in this video on Friday, this usual Friday video, ChatGPT may be more of an enabler, allowing sellers on Fiverr to sell even more, even faster, even quicker, and maybe not directly a threat. But that's just what we'll see. And these stocks are generally fairly cheap, aside from Etsy, which is a bit expensive, but they're generally fairly cheap, especially when we consider how good of a business model this is. And when you look at the gross margin, we can tell pretty good business model in my humble view. All right, this was it for this video about entertainment. This is just entertainment. I hope you were entertained. There is no investment advice ever on this channel. I am going back to my vacation. Thank you so much for your support. Appreciate all of your likes. Appreciate all of the subscribes. All of the support is appreciated. Helps me keep going. Thank you so much. Appreciate the comments. Have a great day and have a great weekend.